Welcome to Live at the Nut Bar. We're recording from the Nut Bar at Squirrel, and today the theme is the housing market and is it stuck in the mud? So that's the sort of the theme today. Our guests are Mary Jo Vergara from Kiwibank, an economist at Kiwibank. Thank you for joining us. We'll call you MJ.
Yep.
And John Bolton, we'll call you JB, reappearing on Nut Bar from Squirrel. Hey, so the OCR's down 2.25%, house prices sort of rocketed, then came back, probably to trend, you'd sort of say. You know, housing turnover is back at the sort of average level of the last 10 years, but it feels like we're really stuck in a rut. So what's, Mary Jo, MJ, what's going on in the market that makes us feel so gloomy about it, I guess?
Yeah, I guess it's, we're still coming off a really deep recession we had last year. Economic output declined, I think, cumulative 2% last year, just over 2 quarters. That's quite a deep recession. So we're just crawling ourselves out of that. Right now, we're seeing kind of this multi-speed economy developing. We've got, primary industries, tourism doing quite well, but those kind of, interest rate sensitive sectors, retail, hospitality, still doing quite weak. And that's because the consumer hasn't really come into play yet. The housing market's still quite soft. So the housing market, as you say, stuck in a rut, it's kind of lost momentum. We've been trading sideways in terms of house prices for the last 2 years.
Yeah, in fact, house prices fell in June, didn't they, on average across the country?
Yeah, that broke a run since November of some modest house price gains. So we're starting to see some momentum build, but just, 1 month it kind of dropped. It is the winter period, and it's usually a quiet time for the housing market. We're really waiting for spring and the summer months to see, hopefully a bit more activity in that space.
So we're sort of really struggling to get out of that rut. And that rut was probably even deeper than on the face of it because of population growth. So
Absolutely.
Per capita GDP is down a scary, probably 5+%.
Yeah, it was deeper than the GFC, which is quite telling, and also over a shorter amount of time as well. So on a per capita basis, which excludes all that noise from population growth, tells you really that households, businesses, were doing it tough.
Have we been the worst performing economy in the world?
We're probably not far from it.
Yeah.
It follows such aggressive rate hikes that the Reserve Bank delivered. I think it was one of the most aggressive tightening policies around central banks. So, they were trying to restore balance in the economy to get inflation down. Probably didn't need to go all the way up to the peak in the cash rate.
I think we did quite a few podcasts that I wrote an open letter to the Reserve Bank governor a couple of years ago, which got good coverage. JB, what's your perspective on the state of the market?
I guess New Zealand's been living in this fake bubble for a very long time, right, where fundamentally the economy's been driven by immigration and low interest rates, debt-fueled growth. And I kind of, a number of years ago, probably 7 or 8 years ago, I wrote a blog post on what I called the creosote moment, which is you can't rely on continually stuffing Kiwis full of debt as your mechanism to get this country going. It's a false idol.
I guess there was this incredibly long, multi-decade actually decline in interest rates in New Zealand. When I got my mortgage, it was 15%. That was 30 years ago, but then we've had this very long downturn in interest rates, which means we could borrow more. I suppose that's been one of the drivers. But you can only get so low, right? And we're at that sort of, we're back to sort of global.
And it's debt-fueled growth, right?
Yeah.
So look, to the extent that interest rates drop and people decide to use that extra money to go and do things and go and spend money in the economy, that's kind of okay. But this idea that lower interest rates allow Kiwis to borrow more, pay more for each other's houses, just creates a false economy. And we've been like that for decades.
MJ, has part of that been supply constraints?
Yeah, supply is, you look at the housing market and you see, wild swings in house prices, up 46% during that COVID period. You look at it and you think to target demand as a way to fix the housing market, but really the solution is in supply. It's economics 101. When you put more supply to the market, it becomes a more healthier, more, get to equilibrium more. It's what we saw, a perfect test case for that was Christchurch when they had the earthquake. Obviously the housing stock really crumbled under that, but then they flooded it with some supply, and they've had the best performing housing market, both in terms of they didn't see such a big fall in house prices. They've actually outperformed the whole
So it's
nationwide.
almost like Christchurch, Canterbury is the model for the economy, for
Yeah.
the housing part of the economy. I mean, I remember at the time, a decade ago, talking to the government and sort of saying, well, if you want to know how to have an appropriate housing supply, just replicate what you've done in Christchurch. There they brought in workers, mainly many Filipinos. They started out living in hostels. They didn't need to build houses because they started out living in hostels. Now they're integrated into the community, and land was freed up, north and south of Christchurch. So it was sort of the blueprint.
But we didn't. Here's the funny thing: we didn't decide to do that. It happened to us.
Exactly. Yeah, but we learned what worked. And then,
I mean, look, we're not particularly good at making big, hard decisions as a country, right? We've got short election cycles. The risk at the moment is that National's out at the next election, right? Now, they're starting to worry about that quite seriously. You had John Key out this week talking OCR down 1%. They need the lolly water to get this economy going.
We'll come back. Yeah, he talked about, just you're optimistic when your house price is going up, and all the older people that sort of say, oh, my kids won't be able to buy a house. Actually, I think his words were bullshit. People like their house value going up because it makes them optimistic in spending. Hey, before we move on to some scenarios for what the future might look like, JB, there's a big supply of properties on the market. So, I mean, are we through that housing supply shortage, and with immigration much?
Well, I'd say there's two things going on, right? We've got low levels of immigration. We've still got, affordability still not there where it was, because you've got to remember that underlying costs have gone up significantly. There's been some level of income increases, but not really to offset the costs. And interest rates are still higher than they were, back sort of post-COVID, right? People still have huge amounts of debt that they're contending with. People are still needing to save and pay off debt, get their balance sheet looking a bit better. So in that context, house prices can't go up because people simply can't afford it. Right? And then if I take a step back, the other issue that we've got is that the people that are needing to sell into the market, and you could call it a forced sale or a motivated seller, are essentially developers and builders that have built a whole lot of stock. They can't sit on it. They can't rent it out. They need to move it. And when you have a lot of that in market, they meet the market, and when they meet the market, that's why you continue to see price drops when arguably the market's sort of starting to flatten out. The reality is we've still got a lot of people out there that need to sell. And that's going to hold house prices down for a while yet. But the interesting thing is there are microcosms in this market where house prices do go the other way, because it is a supply-demand thing. And that plays out differently in different parts of the market. It's not one big amorphous thing. It gets lost in the averages.
MJ, thinking about the different markets in New Zealand, Auckland, Wellington, Christchurch being the three biggest, how have those three markets behaved? Because they're sort of quite different in some ways, aren't they?
They are very different. You can kind of, I suppose, to some extent, group Auckland and Wellington together, where the housing market has really underperformed Wellington a little bit more. I think house prices are down almost 3% on the year. But Christchurch is just a whole different beast. It's a lot more positive there. Like I said, they didn't see quite the fall in house prices and during that COVID period, and actually they bounced back a lot faster and a lot harder than other regions across the country. It's partly because that earthquake rebuild supported their market, but it's just much more affordable down there. They've really built up the space. The actual region itself has been quite a livable city. They've really built well coming out of that earthquake, and really recovered.
And also strong net migration from the rest of New Zealand, right?
So people are moving that internal migration,
I mean, with house prices several $100,000 cheaper than Auckland or Taronga or Hamilton or even Wellington, that's a big driver, isn't it?
Cheaper, but it's not all that cheap now. Like most of the new builds that we're sort of seeing in the market are getting close to hitting $1 million, if not going over $1 million. Right. So, house prices have moved quite a bit in Christchurch.
And that must be the demand coming there, because people are looking outside their own regions to find somewhere better. So it's just catching up.
Yeah, totally.
Okay, so moving on to thinking about the year ahead, 18 months, 2 years ahead from an economic perspective.
Yeah.
MJ, what are sort of 3 potential scenarios? I mean, economists are always right in the long run. Things either go up or down. But, what are the sort of scenarios we should be thinking about, and what would drive those scenarios, and what would the outcomes sort of be?
Yeah, I guess, okay, so our central scenario is one of a cyclical rebound. So we're, coming out of this recession, interest rates have fallen. The second half of the year, we should see a bit more activity in terms of consumption, households, because we've got this wave of mortgage refixing coming on. In the side of, I think it's like 81% of the book at the start of the year was due to roll off. So we're expecting this rebound in economic activity in the second half of the year. Obviously, a big risk to that is what's happening overseas.
So just picking up that theme,
Yeah.
my mortgage rate's going down from, most people had repriced up to sort of over 6, often sometimes 7%. From very low rates. We're now at sort of high 4s for most fixed terms. So why haven't we seen a rebound with that significant drop, or is everyone just going, phew, I can now, survive as opposed to going backwards? Is that really what we've seen so far? And why would that be any different over the second half of this year, even if interest rates for most people are going to...
I've got a view on that, and I think it lends itself to the wealth effect, which John Key was talking about, which is Kiwis feel better when their house price is going up. You got to remember, we borrow and spend, and what we're not doing at the moment is borrowing and spending. So yes, the interest rates have come down. Yes, it leaves a little bit more money in people's back pockets. To be honest, I think people would rather consolidate, pay off a bit of debt, build up a little bit of sort of savings, kind of get their life back in order, then sort of suddenly go on a bit of a splurge.
Apart from overseas holidays, stand out, eh?
Yeah, to go on a bit of a splurge, people need to feel wealthier. And I think they do need house prices sort of at least stabilising, not going backwards. They need job certainty. It's all of these things are really important.
So back into the central
I'm
scenario,
really
what are the
whispering my answers into JB's ear here.
What are the other components of that central scenario? So, big wave of mortgages, interest rates down for people.
Yeah.
So that sort of will see a recovery progressively over the 6-12 months ahead?
Yeah, it's really going into 2026, because when you have a much stronger consumer, businesses will feel, in a place where they can start to potentially invest and start to hire more, because we're hearing, and in surveys, we're seeing that businesses, what's really the main constraint on them is sales, is the demand side. Previously it was labour, not being able to find labour was really the constraint, and they couldn't meet demand because they don't have the workers there. Now that's really flipped, and that demand is really the biggest, constraint on their business. So when we see a much healthier household that's starting to spend a little bit more, you need the housing market to come into play there with that wealth effect. You'll start to see business and investment intentions start to pick up, which is really your source of growth. We talk about debt-fueled kind of recoveries or activity. It's what that debt's being used for, and if it's going in predominantly into housing, that's not really the most productive asset. It needs to be going into businesses to grow.
So the other part is the agri sort of sector. It's almost like we've got a two-speed economy. Agri is booming, the word.
Yeah, it is. We've had, commodity prices elevated, particularly for meat and dairy. So that's really helped, activity there. Also, the New Zealand dollar exchange rate has been quite favourable. It's not been as strong. So, a lower dollar helps with our exports. So they've had it quite well. But that is very vulnerable to what's happening overseas. So just as quickly as we've seen commodity prices rise, as soon as demand hits those exports and those prices fall, we don't have that. So basically the Reserve Bank, we need a more broad-based economic recovery here. We can't just rely on agri and tourism to lead us out of here.
I recall maybe probably going back 15, 20 years, agri-led recovery was a badge, economists were using. I can't remember the exact time, but you were probably in kindy still then. But,
Yeah.
but is that part of the story in agri-led recovery? Like, when do we see that filter through to the provincial centres, or is that already happening? Like, what's the playbook look like there?
It is happening a little bit, I think. Part of the reason why Canterbury region as a whole, not just Christchurch, but the region as a whole has outperformed, because we've been looking at the regions recently. Why that region has outperformed is because of this, terms of trade being so strong, farmers doing quite well. So that's really led their activity within that region outperforming our main centres like Auckland and Wellington, which most of the time the activity there has been led by a strong housing market. So it's been it is filtering through, but to make it more broad-based, we do need other sectors of the economy to pick up.
So you described it as the sort of central scenario. What does that mean in the OCRs and how that flows through to mortgage rates?
So in our central scenario, we still had the cash rate going down to 2.5%. Again, it's just about guaranteeing this recovery that we've already started to see and making it more widespread. We just need more rate relief. We have seen quite a big fall in interest rates, but we need the cash rate to be below neutral, which is kind of the Goldilocks rate.
I mean, the reality is, monetary policy, it's there to control inflation, but when you're in a recession, normally interest rates are low. We've been in a recession with interest rates high and very loath to lower them until we started. Now, 2.25% down, but all we've come back to is a neutral sort of rate, would you say?
Yeah, neutral is kind of that Goldilocks rate where monetary policy isn't, stimulating growth, nor is it restraining growth, and that's around 3%. Pretty wide confidence bands to it. We think the cash rate needs to go to 2.5%.
To be in stimulatory territory. And that gets that confidence sort of back into the housing market alongside the agri side. And
when you think about the risks to growth, I know the Reserve Bank's mandate is targeting inflation, but you've got these growth concerns in the medium term. What's happening overseas, the potential for a slowdown in global growth, that could see inflation in the medium term undershoot the Reserve Bank's 2% target. And monetary policy is set. It influences the medium term. So when you've got inflation potentially going back down to 2%, potentially below that, you need to be creating some stimulus in the economy to avoid that undershooting.
So MJ or Kiwibank sort of view as the cash rate should be 2.5% and quickly.
Yeah.
Much like John Key. Will it be? And what would it mean for mortgage rates? I mean, what do you think?
We've been saying 2.5% for a while.
In terms of it should be, but little belief that it would.
Look, I don't see it going there super fast. I think it will get there. I was surprised they didn't do 0.25% at the last OCR change. I really felt that there was an opportunity to just keep going. I kind of see 0.25% each OCR change. I kind of feel that we should be down around 2.5% by the end of the year. It'd be really
moderately stimulatory would be how that's described.
Yeah.
What would that mean for mortgage rates, do you think, JB, and house building and confidence and so on?
So that would mean mortgage rates, short-term mortgage rates, 1 year fixed mortgage rates, sort of around 4.2 to 4.5.
Oh, really? That low? Okay.
So low fours. That's about as low as it'll go. Longer-term rates, I don't think will go down too far.
So it's like 3 to 5 year.
So three to 5 year. I think you're pretty much best in market now around 4.95. So the way we're talking about it is splitting your mortgage, putting a bit on a shorter-term rate to take advantage of the rates go a little bit lower, and putting some of it onto a longer term rate.
Sub 5,
Sub 5, because that's about as good as it's going to get.
Yeah. Okay, so that sort of your central sort of scenario in terms of what should happen. What are some other scenarios? Is there everything turns brilliant and interest rates have to go to they're bottomed already? Is there a scenario like that, or what are your other sort of?
Yeah, well, we can kind of play around with the assumptions here, and there could be a scenario where actually things are a lot worse than what our central scenario assumes, that what's happening overseas is actually a lot worse than expected. We see a much deeper slowdown in global growth that trickles down to us because we're a small open economy. We're reliant on what's happening overseas. So if that kind of plays out, we definitely need stimulatory monetary policy then to provide businesses more certainty, more confidence, and just make it a much to help out the environment.
So under that scenario, I wouldn't quite say things turn to custard, but you sort of look at the US, and it's bemused me how it's continued to have such strong economic growth, but it feels like the optimism there comes from the share market. In New Zealand, it comes from interest rates. Is that sort of a bit of a way to characterise what makes the US different from us? Because it sort of seems to have defied gravity, but then the financial results of companies has been pretty good.
Yeah.
Especially the tech sector, of course.
Yeah. You chart consumer confidence against the US share market, and you see that US consumer confidence, they correlate quite nicely. here in New Zealand, you correlate it with house prices, and that probably tells you as much.
So there's a productive sort of driven optimism versus just they say selling houses at ever higher prices sort of optimism.
And we saw a real flurry of activity in US equities at the end of last year. So, it's consumer confidence over there is I think their labour market, their economy is holding up much better.
So the catalyst for that scenario, much weaker and much lower interest rates, is a global meltdown.
Yeah.
Is meltdown the word, or is it?
Yeah, meltdown. Anything that just, big shock to the international economy could lead to a much, will trickle down to a much weaker economy here. Domestically speaking, we are at the beginning of the cyclical rebound. So it's really the risk to our economy is very much coming from offshore.
I mean, ironically, JB, under that scenario, New Zealand probably does quite well, arguably, or not. It's probably more stimulatory for the housing market, for example. Obviously, interest rate sub 4.
Yeah.
Even if
yes and no, right? Because I mean, if you're getting mortgage rates lower, it's because there's going to be a lot of pain in the economy.
God, haven't they had enough?
Well, that's it, right? And I think people feel that way. I mean, it feels like a pretty drawn-out recession.
In many ways, the slowdown in economic growth in Q2 probably reflects, that was, the Trump tariff stuff. We're just seeing that come through in GDP now. Well, we'll get those GDP numbers in 3 months or something like that. But it's felt to us like Q2 has been quite a weak quarter for GDP, and a lot of the house prices sort of come off.
I think this year's been particularly hard for people because I remember there was a famous study done by a psychologist about prisoners of war, and it was the optimistic ones that gave up first. And I think there's something about resilience, which is being true to the situation that you're in. You're more resilient, you last longer. I think one of the challenges for us is that everyone's kind of thought we were getting out of this.
Yeah.
We were
promised, survive till 25, and we're in 25, and it's still survival.
And I think that's part of what's going on at the moment is just this drawn out recession's just got harder and harder for people the longer it's taken.
Well, what we have seen though, MJ, we haven't seen a massive lift in unemployment really. People are holding on. Why is that? Is that people are holding on to employees because employers have gone through that shortage of labour thing? Or is actually the underlying demand there, or?
Yeah, I guess it's a mix of things. So part of it is, firms trying to hold on to their staff for as long as they can. And first they'll cut hours before they cut headcount. And we've seen those hours worked really drop, I think 3%, which is the deepest since, if you exclude COVID, deepest since the GFC. So they are, I think, to some extent holding on to their workers as much as they can. But also the fact that the unemployment rate's at 5.1 looks better than it actually is if you look at the details, because lots of people are actually leaving the labour market, which in itself is a reflection of a weak economy. It kind of masks the unemployment rate a little bit.
Yeah. So that participation rate got really high post-COVID. In fact, I sort of recall it was almost like you were committing a crime if you could work and you didn't, because, Mitre 10 was screaming out for stuff, so older people came back into the workforce to help out almost, and it felt like a social obligation in some ways. So maybe we're back more on trend there.
I think part of it is that correction lower, just normalizing in terms of participation rate. We're right, we saw so many people come off the sidelines. Basically, if you were able to work, there was a job there for you during COVID.
Yeah, I agree, and so there's something quite disappointing that sort of sits underneath this, which is we lose skilled people offshore, and so eventually you get a recovery, and we run into the same old problem that we run into in New Zealand every time. We'll run into skill shortages. Take the construction sector, it really is sort of bottomed out. And we'll be losing a ton of skilled tradies to Australia and offshore, and we won't get them back again. And we're just going to repeat the same old mistake, which is we won't be able to build fast enough.
I guess the point is consistency of infrastructure projects, and you don't want these wild
long-term
swings.
Planning,
interest rate 0, then interest rates 5, and so on. So those wild swings. to a scenario, ultimately the Reserve Bank has got a mandate to target inflation. There are a few other things, but basically it's about inflation. What if inflation, which is, it got to 2, there were a few influences with non-tradables inflation being negative for a bit, but, I think the latest number is it
2.7?
7.
Yeah.
What's the scenario where that pushes up, maybe 3, I don't know. What could lead to that, and could that lead to an increase in the OCR rather than reductions?
I mean, yeah, I guess anything is possible, and you don't never know what the risks are, but we have seen inflation lift to 2.7, mostly because of imported inflation coming much stronger than we've seen in the past. So we used to be importing deflation, now we're actually importing a bit of inflation from overseas. Food prices being up. If we see that kind of continue, that lift in import inflation continue, and it becomes, we see overall inflation lift towards 3%, that's going to start to feed into people's inflation expectations, and it becomes this kind of self-fulfilling thing where expectations lift as well.
So is that why the Reserve Bank, it feels a reluctant cutter now of interest, lowering the OCR? Is that a fair summation? Because they're worried about inflation?
Yeah.
But have they got the horizon right there, do you think?
The reason why they paused, I think, is because they wanted to see, they're expecting inflation to rise, but they were wanting to see what exactly is driving that rise in inflation. And when we saw the report a couple of days ago, there was nothing in the report to suggest that this lift in inflation will be persistent. It does very much seem like a temporary bounce. Food prices were the main drivers for the increase, and that's a seasonal lift. And there are also these things called administered costs, things like electricity being quite high, council rates being quite high, that the Reserve Bank doesn't really have much control over.
Government charges and that sort of thing.
Yeah,
yeah.
That's pretty chunky, 12.2%. I think council rates are up. So I think they wanted to see what's driving the rise in inflation, and it doesn't look like it's something that's going to be persistent. We should see it like a spike. It goes up and it goes back down.
Do you reckon that's JB, what the RB will do? Look through?
Yeah, I do, and I think it's pretty short term. I mean, there's this view that globalization's probably, reversing a little bit, certainly with what Trump and stuff's doing overseas. So that's introducing a little bit more sort of inflation into the global system. There's another thing that's sitting on the horizon, which is, artificial intelligence. And, if we think globalization was deflationary, I think artificial intelligence has a massive power to be a deflationary force. Yeah. So I just, when I look out over the next 5 to 10 years with the speed of the structural shift that's going to occur, I think there's going to be the potential for significant amounts of deflation coming into the global economy off the back of AI.
Wouldn't we love to see that in council rates, come through to council rates?
That's the last thing it will impact. But,
yeah.
But it's serious, and I think it's going to be a really interesting 5 to 10 yees, and I don't think anyone's really got any idea what the impact will be. Are you guys even sort of starting to model it and think about it?
It's also moving so quickly. All the developments happening in AI, it will definitely have an impact on the labor market.
Yeah.
I think we're already starting to hear of anecdotes where they're using it to kind of replace entry-level roles, those kind of very labor kind of led, very kind of desk kind of heavy work. So it's definitely going to have an impact on the labor market, but where there'll be an impact in terms of loss of jobs, it could create new jobs as well.
Yeah, I mean, and through hundreds of years of progress, economic progress and innovation and so on, there have been new jobs created. And, you look back to New Zealand 30 or 40 years ago, half the jobs that were big then don't exist now, but unemployment's low still. So, yeah, you can scaremonger. But, there's, just in our own business at Squirrel, we some tech stuff that was going to take a couple of years, is probably going to be done in 3 months with their developers using AI to rewrite code as opposed to, coding themselves. And they love it because they do the fun value add stuff as opposed to the detailed
manual
coding
entry
stuff. But I'm with you, JB, is that I think economists globally have underestimated the revolution that is AI and the impact on deflation, because the price of things will drop because they're driven by far more efficient computer-driven processes and that. So you're sounding like you put a pretty low probability on inflation gets out of control and interest rates have to rise.
Yeah, I'd say so. It doesn't seem like inflation is going to, be taking off anytime soon. That would require the Reserve Bank to come in and start hiking interest rates. I think of all three scenarios, I'd probably put the lowest probability in that one.
Let's sort of look forward a lot further. That's sort of the next 10 years. So how do house prices likely pay out over the next decade? Is it going to be like the last decade? Like maybe start JB with what's the last decade or two?
Well, I'll start. I think it's a fallacy to take the last 30 years and apply it to the future, and I see that way too often. So if we looked over the last 30 years, house prices on average went up 5-6% a year. And therefore they're going to go up 5 or 6% a year.
So you just borrowed as much as you could, and owning a house was...
There's two fundamental things that are wrong with that assumption, right? There's actually plenty. But the first is that we've gone from a high interest rate environment to a low interest rate world. So that makes a massive difference to house prices, right?
So we haven't got that transmission from high to low. We're at long run.
Yeah. So we've seen the benefit of that flow through to house prices. That's a one-off. So that's kind of gone. Look, the next thing for me is that we're pretty much at that creosote moment where people are maxed out on debt. The affordability is not there really for them to take on more debt. So you're not going to get debt fueled growth, and I think that's going to be a dampener on the New Zealand economy generally. Because don't underestimate how much of the growth in our economy has come from people basically gearing up on property. I think back to when we first got into banking, and the total mortgage outstanding at the time was about 70 billion, and now we're probably 400 billion.
Yeah,
400 billion. So there's been almost six-fold increase in household debt.
That is 30 years though, JB.
That is 30 years. I look younger than that, but that is 30 years. But that's a lot of money that's basically gone into the economy through debt expansion. And then the final point for me would be, generally speaking, house prices should follow increases in incomes. Like if you're maxed out on debt and you can't really borrow anymore, then it's pure maths and logic that basically house prices long term should follow income growth. So the question really comes down to, are we going to improve incomes in New Zealand? Are we going to get, per capita incomes up? Are we going to get that GDP growth? Is that GDP growth going to be shared? Who gets the spoils? How much of that's going to flow through to income growth? And then that underlying income growth will flow through to the housing market.
So MJ, does Kiwibank forecast sort of about 10 years in terms of what your trends in terms of house prices, for example?
Yeah, 10 years. 10 years. Like I almost coughed up there. That's quite far out. I think we look at kind of the next 3 to 5 years. For beyond that, we kind of take out the crystal ball, and they'll probably tell me what I want to say. But 3 to 5 years, I think it's more of just the cyclical rebound, falling into his fallacy. It's going back to around 5-7%, and that's just based on what we've seen in the past, kind of that trend develop. But further out, it really just depends on those supply and demand dynamics.
Yeah. Okay. Does AI have an impact on supply, do you reckon, in terms of, technology making house building cheaper, materials and everything, do you reckon, JB?
Well, I think you're going to see a lot of innovation occurring in the construction sector generally. I think we'll get better at it. I think technology is playing a pretty significant role in that. AI, robotics, just generally getting better at building. Like a lot of the young builders we see coming through now have good systems and processes. They're not just builders, they're actually businesses, and they behave like businesses. And it's really good. It's a really positive thing. I think that the impact of AI is a much broader based impact on the economy. And I think these things will have impacts that we just can't foresee at the moment around the way consumers behave, the way they interact, around price discovery, around competition. I mean, arguably in a world with perfect information, economists love that, right? You're going to get a lot better market. You're going to get a lot more competition. That's going to be good for the consumer.
Yeah, but AI will have massive efficiency gains. You know, looking over Australia, I was starting to see some reports that they're using AI within the mining industry, which is, you know, you think it's quite one of the last that would be kind of using that, but it's become, they're using it in more efficient ways. So, you know, construction could follow that direction.
Or even the guys just over the road, you know, Halter. I mean, great New Zealand success story, you know, putting collars on cows.
Yeah, and you know, with your finger drawing the paddock on your mat that you want your cows in, and the cows stay in that paddock with, you know, sound and things like that. Yeah, it's extraordinary technology, eh? So sort of wrapping up, what JB advice for sort of first home buyers, investors, movers? So let's start with movers. What's you know, there's a new reality, isn't it? Which isn't that prices are 25-30% higher. So
what, movers now or movers in 10 years?
Movers now. I mean, you just accept the market as you're a buyer and a seller.
Yeah,
so.
look, I think the challenge for movers is we encounter people that are like, hey, now's a good time to buy because, you know, house prices are down. There's more choice out there. The challenge for movers is that they've got to sell to buy. And how you make that work. And I think you're right, Dave. If you're prepared to meet the market and you know that you're buying and selling in a soft market and it's not about trying to make money, it's about trying to move from one property to another, then you can successfully do that.
Do many movers, you know, sell, rent, then buy? Is
They
that a
don't
good
like
strategy?
to.
No, it's...
In a perfect world, you buy and then hopefully sell.
So being realistic, meeting the market on, you know, both sides of it. You've got choice, I guess, if you're buying, but
it's hard, right? Because for movers, there's all that uncertainty that sits around it. I mean, will I even be able to sell my house? You know, so I think movers aren't really in the market yet. They're too nervous. There's too much going on.
So housing days to sell coming down, and there's just more activity and
well,
optimism.
ironically, now's probably the perfect time for them to be in.
Yeah.
Because the problem we see on the other side is when the market takes off again, their problem is they can't find anything to buy. Yeah. You know, they can sell, but now they can't buy.
So perfect time for movers. What about first home buyers? Good.
Well, it's clearly a good time for first home buyers with house prices down.
Yeah.
And look, I guess particularly with builders and developers with a lot of entry-level stock in the market, like arguably if the market's flooded in any one part of the market, it's entry-level. You know, there's a lot of new build stuff that's kind of sitting around that needs to be sold, that is helping hold those entry-level prices down.
So Goldilocks time for first-home buyers. What about investors? That's an interesting one because, you know, rental yields, if you're not getting big house price appreciation, rental yields.
Well, if I was an investor at the moment, I'd be buying full sites.
Buying what?
Full sites, 800 square metre lots. I'd be buying up all the old stock. That at some point needs to be knocked down and build some townhouses on it.
Or a do-up or sell to a first home buyer who will do the do-up.
Yeah. Look, there's opportunities out there for investors, but I think, you know, for investors, I often think, you know, it's the ones that are more active, the ones that are prepared to look at a property and go, what's my upside on it, as opposed to just shoot and hope. You know, I don't know that shoot and hope necessarily works.
So buy anything, rent it out, and have a running yield. You know, you're paying more on interest than your rental yield because the capital appreciation is going to happen. This is actually about more buying smarter, is it?
Yeah, look, you tend to get two types of investors. You get the passive investors that have high income. They just want some diversified investment. Some of that will go into property. They're not going to spend too much time thinking about it. They want someone to do that work for them. They'll just buy something, hold it long term, and just on the basis that it will do well in the long run, right? And they're always in market. They're in market at the moment. You get another kind of investor, which is the Kiwi grafter. Now, they're the ones that don't necessarily have high incomes. They see property as a mechanism that can help them advance themselves, get ahead.
Through capital appreciation has been their golden egg, hasn't it?
Yeah, and actually doing the hard yards,
work, okay.
right? Yeah. Doing the work. And so often they've come off the back of property seminars and you know, these property groups that go charging around convincing everyone to buy property. Often they come off the back of that, but there's a ton of those Kiwi grafters that do the hard yards, and they've been very successful. Some of them have done incredibly well. The challenge for them is that, we have DTI speed limits, debt to income ratios, 7, which for larger property investors is actually quite challenging. We've got high servicing rates, we've got relatively tight credit policy for those kind of investors. So their challenges, even when they see good deals out there at the moment, they're struggling to get them over the line.
Yeah, so the investor market's probably going to stay fairly weak for a while with these new sort of tools that the Reserve Bank's got.
Yeah, well, the lower interest rates certainly won't flow through into the investor market like it used to. But that's by design, right? That's exactly why the Reserve Bank's got DTI limits.
And final question for you, when do developers start dialing up? Because they've been dialing down in terms of activity the last year or so, haven't they?
I think they're still there and they're still keen to do stuff. Most developers that I talk to, they thought this year was going to be a little bit better than it is, but I think most of them know that the market will come back, and so they are trying to continue to invest. I think one of the big things is that the banks were incredibly negative on construction last year, and probably even early this year, but the banks are starting to come back into the market. We're starting to see banks funding developers again, which is good because it's always lower cost funding. But that's a sign that they've seen the bottom. I think even banks are confident in the next year or so we'll see that property market start to pick up again.
Okay.
So,
and in terms of, just to finish up, MJ, what are the things to watch in terms of the recovery? Because it's almost like it will happen and then the media will start to talk about it. So what are the things to keep an eye on?
Yeah, I guess there's just so much uncertainty. What's happening overseas is always something that we're keeping an eye on. When those trade tariffs are actually going to be finalized, they just keep getting pushed out. But that is the big uncertainty there. But also uncertainty, we kind of touched on at the very beginning about what the next election cycle might turn, but what the result might be, because if, investors or businesses are concerned about a change in government, potentially at the end of next year, but making decisions on that now, that too will stall growth domestically. So that's a big risk to the outlook as well. But we are optimistic about where the New Zealand economy is headed, going into next year. It is going to be a better year than last year. That's not very hard though, because last year was quite a terrible year. But the growth really should come when we see this wave of refixing come. There's a lot of households out there that are waiting to get onto those lower rates, and that should see disposable incomes lift and see that really trickle throughout the...
There are a handful of people with 2.995-year rates.
No way. Oh, wow.
But it's a handful of years. So I mean, the ingredients are there, but nevertheless, you'd argue for a more stimulatory settings, and I guess that's based on the expectation that inflation is headed back towards 2% pretty rapidly, which should be the horizon of the Reserve Bank. Yeah,
that medium term, you see inflation lowered, you're seeing growth right now being quite weak, like you're saying. Q2 could be another weak quarter. So we won't see that same growth that we saw at the end of last year, at the beginning of this year, continue. It just needs that stimulus from the Reserve Bank.
Yeah. I mean, it's interesting when you look at confidence surveys, when asked, are you better off or worse off than a year ago? It's a very natural weighting or high weighting towards I'm worse off, but how are you feeling about the year and 5 years ahead? Everyone's really optimistic. So let's adopt that optimistic attitude. Things will become easier for the New Zealand economy over the year ahead. I think it's sort of fairly universal sort of expectation. But then we were saying that a year ago, so watch those. Watch for those signs. That's us for another month. Thanks, guys. Appreciate your input. Cheers. Thanks for listening to today's podcast. If you have any questions or things you'd like us to talk about in the future, get in touch with us at david@squirrel.co.nz or john@squirrel.co.nz. And please do share this and subscribe anywhere you get your podcasts. The opinions expressed in this podcast are not financial advice or a recommendation of any financial product. Any commentary provided are personal views and are not necessarily representative of the opinions of Squirrel. As always, we recommend seeking professional investment or mortgage advice before taking any action.